The topic for today is mitigation. So it's actually a very interesting one. Not really a strategy thing at all, right? I think maybe in the next video we'll talk about a strategy concept, right? But this video is just on mitigation. It's not really a strategy thing. So what is mitigation, if you're asked? What is mitigation? Now mitigation can actually mean two things if you actually view it in a different perspective. Mitigation simply means the reduction of risk. If we are going by English terms or dictionary meaning, it simply means the reduction of risk, right? The reduction of risk of any particular thing. If I say, okay, I want to mitigate the problems of bad roads in Nigeria, it simply means I want to reduce the risk of bad road, right? So that is just simply what mitigation is in actual terms. But what is mitigation in trading, right? So we use the term mitigation to kind of indicate an area where price has reacted to, right? So I want to look at it in two ways. The core purpose or the core purpose or the core intent of mitigation of prices is simply filling inefficiencies, right? So what are inefficiencies? Inefficiencies are improper moves or improper moves in the market. Let me not use another grammar. Improper moves in the market, right? So this is an inefficiency in price around here. This is an inefficiency in price around here. I'm going to be using this photo. That's an inefficiency in price. You can see price just sold. There were no sellers. Price just bought all through. That's an inefficiency. So I want to look at mitigation in this way. Mitigation is simply price fulfilling inefficiencies at either a zone that is not a supply and demand and a zone that is a supply and demand, S and D zones. So it is in two ways: fulfillment or rebalancing of price, and what's fulfillment and rebalancing of price at POIs. So if price actually comes back to trade this inefficiency, it means price has mitigated the price. The market has mitigated the price around here, right? But if price comes back to trade around this area, and then possibly price just reacts around here, you can say that price has fulfilled the mitigation of the order around there, and has also reacted to the inefficiency as well. So that is why, if you've actually been very attentive, if you're very attentive, we talk about valid order blocks as one which actually has an imbalance very close to it. So I'm going to be using EU for this example, right? Like I said, this is not a strategy video. This is just a general knowledge video on what mitigation is and how you can actually avoid zones that has been mitigated, right? So coming to EU, I can see this very beautiful price action around this area, and we can actually see an uptrend. You can actually see this is an uptrend: higher high, higher low, higher high, higher low, higher high, higher low, higher high, before price took out the previous higher high, then changed trend for a bit. Same thing happened, and then price, boom, resumed the uptrend, and then kept on seeing something like this, right? So very beautiful price action on EU last week or last 2 weeks thereabout. So this is on a 45 minutes time frame, right? So when price actually breaks structure, like I said, when price actually breaks structure, or just something like a BOS, the intent of price is to actually continue in a specific direction, right? So if price is breaking structure and moving up, the intent of price is to continue in this upward direction until there's been a break of the low, right? So mitigation is something you have to view. It is something you view based on perspective of how you trade, right? Based on perspective of how you trade. Now let us look at this. Like I said, this is not a strategy video, but I think the next video, most persons are struggling with this. Most persons are struggling with mapping out a valid order block or a valid point of interest, right? I think that's the most important video I should make. I thought of reserving it for only paid students, but then I think it's the general knowledge everybody needs to avoid making some certain type of mistakes, right? So most of my videos, I just tend to keep it away. So I'll prepare that video, and it will bless your eyes in coming days, right? So this is a break of structure. You can see this is a break of structure. That's the break of structure, and price would actually come back to feel what's this inefficiency in price around here. Price will come back to feel that inefficiency around there, right? Price will come back to feel it, right? So we can start to look for our points of interest around this area. So I like to use my GAM box to mark out my points of interest, so you can correctively or you can accurately pinpoint. You can accurately enter 50% of the order block. So this is the order block, the last bearish candle before the bullish break, right? So I mapped it out completely. Some persons might actually use the 100% entry, some person might use the 50% entry, right? Depending on how you actually look at it. So this is place that should be my first target. The external range liquidity around that area should be my first target. So price actually did what? Price actually came back up. Price came down and traded and cleared this inefficiency and kind of like fulfilled the mitigation of the points of interest, right? Remember, mitigation simply means fulfillment and rebalancing of price, right? So the market does this at inefficiencies or at inefficiencies where there are supply and demand. So as usual, our SLs will be below the invalidation zone, and the invalidation zone is below this low, below this protected low, right? That should be the invalidation zone. And you can see your weights. You're left with what? 3.6 hour trade. If you leverage this on your MT5, risking $200 or $100, you're in for like very good amount of money into this time, right? So this is one very beautiful one. And so price actually, like I said, when there's a break of structure, it continues in its inherent trend. So price will keep on going up, continuing the bullish move rather. So there's another break of structure. Again, there is an inefficiency that price needs to come back to fill, and this time around the inefficiency is what? It is close to a point of interest and order block, right? That inefficiency, price needs to come back and fill this inefficiency. Hope you can see it. Come back and fill this inefficiency in price there, right? So, and this is our order block. This is our order block around this area. You can see this continuation was a very clean one. If we actually target this next external range, right? Target this next external range, should be having a very good 1:3 hour trade as well. 1:2.9, 1:3.04, right? So can you see how very clean that is? Very clean, right? So mitigation, again, like I would say, is when price actually fulfills two things: rebalancing, when price fulfills and rebalances price, right? So the market cannot keep going up and up and up and up and up. That is why there must always be rebalance, right? I think when I was learning, one of the most curious questions I had then was that why is it that price always comes down after going up, right? Because I was like, I don't understand how something that is favorable wants to just turn to something else to get. So price actually comes back towards the intent of price when it's coming back is towards rebalance the movement of price. So price cannot create an inefficiency like this and then just keep going up. Price will still come back to trade that inefficiency, and then if there's an order block around it, price will trigger it or mitigate it as we are looking at today, and then price will do what? Continue in its movement. So you can see that the price is always very attracted to imbalances and inducements. I think in the video I made for the X100 and ground students, okay, that was like not a video, actually was one of the classes we had, and I told them that price actually is attracted towards inefficiencies, which is like imbalances. This is an imbalance. For it to be here, it would attract price in the future around that place. Why is this no colored? In Nokwa. Alright, I think it's with a yellow color now. We'll have to brighten it up 100% capacity. So for this inefficiency to be here, price is going to be attracted to come back up to trade around this place to, like, rebalance price, rebalance the inefficiency or the gap that price left around this place, right? And so that's why we can actually see a beautiful price action that happened around here, right? A beautiful price action that happened around here, and boom, price actually reacted from there. So we target this particular low now, following the trend. If you target this particular low as your external range, target the particular low as your external range, as our external range liquidity, price looks to take out liquidity from both ends, internal and external, right? We should be having a very good trade. That if we leverage this on our trading platforms, we should be in for a lot of money, right? So this is it. Beautiful one. Beautiful 6.6 hour trade, right? So we can keep going on and on and on and on and on, right? So I'm going to show you in cases where you would have actually avoided a loss if you actually knew what mitigation was, right? So this is also an inefficiency in price, simply telling us that price will come to react around this area, or price would want to trade around this area. Now, me seeing this thing, kind of strategy I trade, I can actually see my mitigation block, right? Sorry, I can actually see my mitigation block being the most reasonable point of interest I can actually pick, and you can see what price did. Price, bounced on this mitigation block before what? Boom, taking off, right? Before taking off. So the same thing happened here. I think maybe we should expect EU to feel these inefficiencies below, right? And possibly stop around here. I'm not giving a future prediction, I'm just saying, right? Possibly stop around here. So I think this entry, I got this entry last week. This is a break. This is an order block, right? Another block. This is another block. You can see how price is reacting from that area. That is another block. There has been a shift in price trend. There's been a shift. There's been a shift. That's another block, and maybe we should expect some price to like trade lower to these inefficiencies. Who knows? Or possibly just come and do something like this, right? Maybe it's not a time for price to trade the inefficiency, right? Maybe possibly do this. Maybe later on in the future, price will come down to trade that inefficiency, or never trade the inefficiency. Any of them works, right? So this is another block that is very close to, again, like I said, an inefficiency in price. An inefficiency in price is just when price kind of like just moves in a certain direction without any retracement. So you can see that there's no retracement here whatsoever, right? No single retracement here whatsoever. Price just kept dumping, right? So this is an inefficiency price will be attracted to fill, and that was why this other block got filled. Possibly this can actually do 1:3 before moving up, right? So I think this video is really long. I would cut this one and then we'll make another one, 2 more, kind of like show you how to avoid trading from an already mitigated zone, because a zone might be mitigated and there are no orders on it, and then you're trading from a mitigated zone where there are no orders, and you'd be kind of like caught unawares, right? So with that, we've come to the end of this video. I'll see you in the next video.